As all eyes were on the GameStop saga in Washington, D.C., the stock market actually had its worst day in the month of February. Now, that's not really saying much. We were only down about 0.5% here today, but the month of February has been going pretty smoothly up until the last 3 sessions, all of which have been to the downside. So things have gotten a little bit rockier here. Some of the growth stocks have pulled back on a little bit more consistent basis. But for the most part, the trends are still holding. We continue to trade above rising moving averages. In fact, we have a bullish intermediate confirmation signal on the Russell 2000 here today. So we'll take a look at all of that in tonight's video. Then we'll get into our trade application example, where I wanted to feature a technology stock that's pulled back to its 30-day moving average, had a nice bounce up and off of that moving average here today. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 18th, 2021. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, go down to our description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me. My handle is @BrandonVanZ. We really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we also have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into the activity here today. And you can see I've got chart 4B pulled up here in front of us. This is a simple 4-grid that will allow us to see all 4 of the major U.S. equity indices right next to one another to see if there are any differences. Right now, it does look like the Russell 2000 has sold off a little bit more violently than the other two. We were down 1.67%. I should say the other 3, but in this case, nonetheless, this is the worst performer today. It was the only one out of these 4 indices that was down over 1% here today. So it was a pretty aggressive sell-off there on the Russell 2000. However, when you take a kind of a 30,000 foot level view of things, you'll see that yes, while we have sold off for 3 straight sessions here on the Russell 2000, we still have not even touched the 30-day moving average in over 3 months, right? We got close to it here and here, we got close to it here, but we never actually even touched it. That is incredibly rare. You can see that for the other indices, we've touched the moving average at least once, multiple times in the case of the Dow Jones. But anyway, we've been in a tremendous bullish run here for the last several months, really since the first week of November when we had the Pfizer vaccine news. And so at any point, we could, of course, give back a sizable amount of those moves that we've been making here recently, and it wouldn't be entirely surprising, right? That's the stock market for you. It doesn't go straight up and straight down. Right now, we do have to be on the lookout for the possibility of a broken support level, but we don't actually have one in front of us. Now, every chart is, of course, unique in nature, so there are obviously individual stocks that are suffering, but on a portfolio-wide level or an index-wide level, all 4 of these charts that we see in front of us continue to have this dark green background color, telling us that the intermediate posture using the market forecast technical indicator is still strongly bullish. And I would suspect that will continue to be the case unless we start breaking down below the 30-day moving averages. If that starts occurring, then all bets are off. But as of right now, we have to make the assumption that trends hold until they don't. And right now is a pullback within a greater trend, but it is not a sizable pullback. This is not even one that should be making very many people sweat, unless you just haven't experienced a drawdown all that often. But this is perfectly normal behavior within a strong stock market. You know, the breathe in, breathe out philosophy is still on track. And, you know, this is an opportunity for those of you that have been waiting to get into small caps to have an excuse to do that now with that bullish intermediate confirmation signal that I mentioned before. Remember, that occurs when we have a bullish green line, and since it's in the upper reversal zone, whether it's going up or down, we consider that to be strongly bullish at this moment in time. And then that is combined with a red line that's in the lower reversal zone. That's our momentum line on the market forecast. So basically what that's telling us is that the green line is telling us that we have a strong trend. That should be obvious. We're looking at that chart, higher highs and higher lows for 3 months. The red line is the most sensitive of the market forecast lines. And so whenever we do get a pullback like we are experiencing right now, that particular indicator or that line has a good chance to make it into the lower reversal zone. In other words, kind of recognizing the sell-off in its nature. So longer term uptrend short-term downtrend. The question is, where do we go from here? And since the candles are still above a rising 30-day moving average, I think a lot of folks are going to bet that we're going to find a little bit of a bounce at this level and head higher again. And if that's your mindset, then this is that excuse to take advantage of the buy the dips mentality. All in all, things are going pretty smoothly here. Just to wrap it up here, you can see S&P 500 officially was down 0.44% today. Dow Jones Industrial Average was down 0.38% today. NASDAQ Composite was down 0.72% today. And then, as I mentioned previously, Russell 2000 was down 1.67% today. Let's take a look at the 3 green arrow chart now. I'll be curious to see if we've lost any arrows here in the last couple of days. And this will be chart 4D for those of you that are premium members following along at home. And a friendly reminder to those of you that were our 2018 premium members, your subscriptions are coming due later this year, and you should have received emails from David and I about that. But remember that you've only got about another week and a half before our discount gets clipped a little bit. We're kind of using a sliding scale on that from now until June. So some of you might have been holding off until the last minute here, and just a friendly reminder that you've only got a week and a half yet to take advantage of that maximum discount there. Anyway, for those of you that are premium members, you know that we give you access to our, I think it's 52 customized charts at this point. And so 4D is the one I'm on here now. And this is our 3 green arrows setup, as you can see up here in the label itself. Now, 3 green arrows, for those of you that are not as familiar with it, is just simply looking at 3 different technical indicators on one chart, trying to determine if those 3 indicators are bullish all at the same time or not. And right now, my gut was telling me we probably did not have 3 green arrows anymore due to the 3-day sell-off that we've been going through, and that is the case. The 2 bottom charts no longer have 3 green arrows. Now remember, on these customized charts, we make it easy for you to recognize that by looking at the background color of the chart itself. So background color right behind the candle on the NASDAQ Composite and right behind today's candle on the Russell 2000 is white. And that's telling us that we have a mix of green and red arrows. If we ever have 3 red arrows, that background color will turn pink. We don't have very many examples of that, but here would be one example of it on the Dow Jones up here for a brief moment in time. So right now, with a white background, it's telling us that with our 3 different indicators, some of them are red arrows, some of them are green arrows. And in both of these bottom charts cases, the culprit is the MACD histogram. Notice that we have a red arrow that came into the NASDAQ Composite yesterday. Same thing happened there on the Russell 2000. So we've got a loss of momentum here. Not a big surprise. Again, we're on a 3-day losing streak at this point. So naturally, you're going to lose some momentum when you're doing that. And it's just been a little bit more aggressive selling there with the NASDAQ and the Russell 2000. Again, we're not making some sort of major trend change or shift at this moment in time. We're just recognizing that in the short term, we've had a little bit of a rollover. And so we've lost some of that steam that we had earlier in the month. The pullback in the S&P 500 hasn't been quite enough to lose its arrows. So right now we continue to have 3 green arrows on both the S&P 500 and the Dow Jones Industrial Average. The S&P 500 is getting awfully close to also going to a red arrow on that MACD histogram. If we have another sell-off day tomorrow, we might very well get a red arrow in that particular case as well. I think the Dow's got a little bit more wiggle room. It does appear like the bars are pretty high off the 0 line there on the MACD histogram for the Dow Jones Industrial Average. So unless it's a really aggressive down day tomorrow, I would suspect that we will continue to maintain a 3 green arrow criteria or philosophy with the Dow Jones Industrial Average going into the weekend. So we'll keep our eye on that. But it is interesting that all of a sudden it seems like the Dow Jones has kind of beefed up a little bit, right? They're kind of known as the slower players oftentimes. They're the big blue chip bellwether types of companies. They don't generally go up as fast as the small caps in the NASDAQ, but they tend not to sell off quite as violently at the same time. And so we're in kind of one of those moments right now where we've got a little bit more sell-off pressure amongst the growth-oriented companies, and the big blue chips are kind of protecting their capital a little bit better up here at these levels. Some of you noticed some of my retweets earlier today. One example, Coca-Cola did raise its dividend again for the 59th straight year. They do it pretty much like clockwork every mid to late February, and are known as not only a dividend aristocrat but a dividend king. So Coca-Cola naturally is the type of company that would be in the Dow Jones Industrial Average. Not the most exciting name on planet Earth. Then again, it is the type of company that can kind of retain value a little bit better. And I think that's kind of the MO of the market right now. It's just looking for a little bit more safety in this 3-day sell-off, and they're finding it there in the Dow Jones Industrial Average. Let's take a look at the longer term trends now, and this one is going to be chart 4C. This is our 1040 crossover method. Remember that these particular charts here are going to be 3 years in length. Each one of the candles is 1 week in length. And what we're looking for here are just crossovers of the moving averages themselves. The orange lines on the chart are 10-week moving averages. The blue lines are 40-week moving averages. This is not something that we see activity on regularly, right? With the 3 green arrows, it's pretty regular for us to come in and see a change on the 3 green arrows or 3 red arrow status from a week-to-week basis. That is not the case with these. These are going to be much less sensitive in terms of where our trade signals are given, because they're dealing with much longer swaths of time. And so in all 4 of our charts right here, we continue to have bullish postures from a longer term perspective. The orange lines are well up and over the blue lines and crossed many, many months ago, and we continue to be on that bullish trajectory at this moment in time. All right, let's go ahead and pop on over here to the internet briefly. I appreciate all of you that help support me on Twitter. I know David does as well, so keep up a great job there. The last time I did the video, it looks like 110 of you came out of the woodwork for us, and I really do appreciate that. Anytime we're up and over 100 likes, I don't think twice about doing the video in a timely manner. If we get less than 100 likes, then we start having those conversations. But for the most part, you guys do a great job supporting us on Twitter. Speaking of Twitter, I saw the really fantastic news here on Twitter a moment ago about the Mars landing and getting some excellent photos up there. So that's really exciting to see technology and humanity push forward and doing our best. And so that's going to be a fun story to follow in the years to come there. Anyway, while we're over here, a friendly reminder that tomorrow David will be teaching his very popular technical analysis class. Now remember, David's a CMT, Chartered Market Technician, and he knows his stuff. Boy, oh boy, there's very few people on this planet that are as well versed in technical analysis as David is. And so if that's been something that you've wanted to work on for yourself and train yourself to become better at technical analysis, that Friday class is going to be the perfect class there for those of you that are both our premium and plus members. And that starts at 1 p.m. Eastern time on Friday. Earlier today, he taught his portfolio management with ETFs class, where he does a great job of assisting his students with looking at foreign ETFs and giving them his macro views and things like that. For my part, I did my question and answer session earlier today. That is now posted for those of you that want to check in on that recording there. We had kind of a little bit of a dividend growth investing theme in our class today, where we talked about Smuckers, and we talked about Genuine Parts, and we talked about Comcast, and we talked about Philip Morris and Altria. We also talked about Procter and Gamble and Con Ed and Colgate and a few others. So definitely heavy on the dividend analysis there today for those of you that like that sort of thing. And that is posted to our Trading Rooms calendar up here for those of you that are premium members. All right, let's get back on track to the Thinkorswim platform and see what other charts we can uncover. And let's do some 12 grid analysis here. And we're going to start with chart 5A, and this will be our asset class 12 grid. All right, now as this pulls up here, this is a friendly reminder that the background colors of the charts will tell us whether the current posture from an intermediate perspective is considered bullish or bearish, according to the market forecast technical indicator. The green backgrounds naturally would suggest a bullish posture, and the red backgrounds or pink backgrounds would suggest a bearish posture. So let's see what we can uncover here. We did see a little bit of a sell-off in oil today, and we'll talk about that here in a little bit when we look at the sector charts, because that did impact things over there as well. But it was a fairly rare down day for oil. Oil has just been such a consistent workhorse for this market for the last 3 months. It's been rather impressive. We're still up about 38% over the last 3 months in oil, but today was a rare 1.5% down day there. We remain at 95 on the intermediate line. Those of you that see these labels here might be wondering, well, where are those numbers coming from? Remember, if you're a premium member and you're here following along with me on your own chart 5A, just simply right-click and then go to maximize sell on whatever miniature chart that you want to look at. When you do that, it blows it up into a big screen like this. And you can see down below what that market forecast technical indicator actually looks like now. So you can see that that 95 in the label can be confirmed with your eyes as far as where is this green line positioned on the market forecast technical indicator right now, which again is at 95 there. So we actually, now that we kind of zoom in here, recognize that we have a bullish intermediate confirmation signal on oil as well. Now this one isn't quite as interesting in my eyes as what we see currently on the Russell 2000, and that's because the blue line has not crossed below 50 yet. So while there has been a pullback of sorts, I guess you could say today, that was a bearish engulfing candle there. It's the body of today is engulfing yesterday's body. It's generally not the most bullish of signs. We might very well have another day or two of sell-off, and when that occurs, you'll likely find, or I should say when or if that occurs, I don't know that it will, but if it does occur, you will likely see the blue line come down a bit more. If on that day, let's say we come down to maybe this level from this candle back here on the 11th, if we still have this signal set up, bullish intermediate confirmation signal, it might be an interesting place to kind of take a little bit of a dip of your toe in the water, because this has been one of our strongest trends on the board from a macro perspective for quite some time. As we start cycling through some of these charts now, let's go through this a little bit different than we normally do, where we can kind of see the zoomed in view of each of these. Here's your 10-year Treasury yields. Now, this has been another big-time story. We talked about this on Tuesday, but this has been driving a lot of activity within the market here recently. Remember, when interest rates are strong, like they have been here recently, it generally favors things like banks over other areas like utilities. And so we've definitely seen a nice little burst higher here in stocks like Wells Fargo recently, and JP Morgan and other financial related assets there. So right now we continue to be on that upward trend. We've got a little bit of a rolling over effect taking place on interest rates right here over the last 2 days, but clearly it would have to start breaking down in a major way for me to start to convince myself that the trend was over, right? This thing can fall quite a bit before it even gets to its moving average. But this is the chart that I've been sharing with you guys for many months at this point that I've just been amazed with, because the thing just does not want to close below its 30-day moving average. It comes down there and touches it a lot. It just doesn't want to close below it. And so this is about the most consistent upward type of a chart that you can look for. So I like what I see here. I continue to expect rising interest rates, at least in the near term. Let's see what else we've got here. This is SPY, so this is more on the broad markets perspective from the United States. Kind of talked about this already, so I'm not going to spend a lot of time on it, but we have lost a little bit of momentum here recently in the last 3 days after receiving this overbought cluster signal, a fairly rare one. Remember, we got another one over here on November 24th. That was followed by about a 3-day, I wouldn't really call it a sell-off, but it kind of was a loss of momentum right there. We did go down a little bit from where we closed on that candle, but it wasn't a major sell-off. This one's been a little bit more aggressive after this overbought cluster signal. So we'll see where it takes us, but again, right now the assumption is that because it's respected its moving average so much, we would assume that the trend will hold until it doesn't. And when it doesn't, we'll let you know, and perhaps our mindset towards our trades will start to change a bit as well. But right now, this is a normal price activity within a bullish market. Here is EFA. This is our foreign developed stocks. Somewhat similar to what we saw with the S&P 500, a little bit of a rolling over that's taking place here. But, in this case, we've got kind of a nice little technical setup. If I were to come into my drawings and get a price level tool here, kind of show you what I'm referencing. If I draw that line there, you can kind of see that that concept of old resistance becoming new support could be an intriguing idea right here. We'll see where it takes us, but right now it looks kind of enticing. We had a long lower shadow on today's candle at a support level that was the old resistance from back here on January 8th and January 14th, and then maybe even a little bit there on January 21st. So that's sort of interesting. Let's keep our eye on that. Here with EEM, again, this is emerging market stocks, a bit of a rollover taking place there, and it's kind of similar where our bottom of our long lower shadow here does kind of touch the tops of this candle from back here on January 25th. So perhaps an excuse, if people are looking for one, to try to support the emerging markets around that area. Here's the preferred stocks, and as I mentioned on Tuesday, these aren't looking quite as healthy anymore. We had a string of time there kind of at the end of December where we had some pretty good oomph to the upside for preferred stocks. Remember, they don't generally move around as violently as common stocks, but this was actually a pretty decent little trend here, and then things decidedly changed. We received this overbought cluster signal here is actually on New Year's Eve, so the last day of 2020, and just like that, there was a flip of the switch going into the new year. We had a pretty ugly bearish engulfing candle there, and it does seem like there's been too much wear and tear on this chart going forward. As I mentioned on Tuesday, part of that might be that interest rate sensitivity there, right? The interest rates are rising, and so any investment that kind of competes with bonds is maybe a little bit worse off on a relative basis. These aren't big things that you see. They kind of work their way out over time. But generally speaking, if you do find that bonds are becoming a little bit more attractive because their interest rates are going up, then it's possible that people would sell off some of their preferred shares to then buy some of those bonds. Again, that's not something that is a major light switch type of a moment, but is something that we want to keep our eyes on going forward. Here's TLT. This is our long-term U.S. Treasury bond, and broken record on this one because we're constantly talking about how this is in a downtrend, and nothing has changed my opinion of that. In fact, we have a bearish trade still on this particular entity right now, a bear call spread. It will expire tomorrow, and so you guys can hear me stop talking about it, but then it might very well open up a situation where if we get a snapback rally, I might very well open up another bear call spread on it for the next options cycle. So we'll see where that takes us, but this has been a consistent theme for months at this point that U.S. long-term treasuries to the downside in price as their yields or interest rates are going up. Foreign bonds here have been breaking down in the last week or so in particular. They were already in a downtrend, but this was really ugly price action right here from February 11th through February 16th. And you might expect a little bit of a short snapback type of a rally, not a trend-changing one, just one to kind of get you back into the groove a bit. And we just have had a whimper out of these right here. You can see we've got these oversold cluster signals here when all of these lines, all the colored lines are in the lower reversal zone at the same time. Of course, we're not using the dotted line here. We're talking about the solid lines. And so we do have those oversold cluster signals here, which could very well lead to some sort of a little pop here. But if it does, it's kind of the same story with TLT in my book. I'd be looking to reload the gun for the bearish side if we could get back up closer to this falling moving average. Right now, we just are in kind of no man's land here, just slowly sinking after this nosedive that we had a few days back. And then here on the HYG, as mentioned on Tuesday, this one's holding up a lot better simply because of what we've been seeing with oil prices. A lot of junk bonds are being raised by companies in the oil patch. And so this is the place to be in the bond market. It's a place where people are willing to take risk, and therefore you're seeing a little bit more capital appreciation from junk bonds than you are from the boring old treasury bonds these days. Here's Bitcoin. It needs no introduction. It's been one of the hottest stories of 2021, and it continues to be the case. While we didn't quite close at a record high today, we did close over the very important $50,000 level, and so it's been impressive to say the least here as we are kind of hanging out at those close to new high territories for Bitcoin. Here is the US dollar, and you can see the US dollar had a down day here today, but we fell right back to a support level, that rising 30-day moving average. So right now we do have a green background color telling us that we have a bullish intermediate posture, but I wouldn't call this a strong trend at this point. It kind of feels like it doesn't know where to go. We had some indications of a reversal over here. And so right now my mindset is that we might very well get a bounce on the US dollar, but that's not necessarily something that I'm expecting to continue over the long term. I think the path of least resistance for the US dollar tends to be to the downside. And I'm not one that is going to get upset about that, because I invest in a lot of stocks that earn revenues and earnings outside of the United States. In fact, we had a good conversation about that today in my Q&A class. And so anyway, I'm not one that fears a falling dollar. If you're in international securities or commodities or even U.S. companies that do a lot of business overseas, it can actually benefit your portfolio. So right now, dollar is kind of holding the line, and I wouldn't be surprised if that kind of holds up for the short term, but months down the line, years down the line, I would expect the dollar to be weaker than where it is today. Here's gold. Gold is interesting because we've got back-to-back oversold cluster signals. We'll see where that takes us. Right now, we're basically sitting at some of those same levels where we were back here in late November. We might have breached them by just a little bit, so that's not the best of signs there, but we're probably overdue for some sort of a bounce back type of a rally in gold here. And then here's oil once again. So we kind of cycled through all of those this time around. Let's go ahead and take a quick peek at our U.S. sectors 12 grid. And from this perspective, you can see we've only got 3 pink charts on the board: discretionary, healthcare, and utilities. Notice that utilities is the only one that has a dark pink background, telling us that we have a strongly bearish posture. The other two are weakly bearish. In other words, there's some storm clouds in the sky, but we don't know if it's going to turn into an actual storm yet. But we do see that healthcare, as just an example, is trading just a hair below its moving average. We don't really like to see that. It was doing a good job of kind of riding that moving average higher for the last 2 or 3 weeks. And now all of a sudden in the last couple of days, it looks like it's feeling somewhat comfortable trading below that moving average. So then the fear would be, will that turn into an actual resistance area there? So we want to keep a close eye on healthcare. Discretionary is a little bit better. Yeah, we have that pink background color, but we're still trading above a rising moving average. In fact, we had some pretty bullish price action here the last couple of days where we closed near the highs of the session. Discretionary was up today despite the market itself being down 0.4%. So anyway, keep your eye on those from an intermediate perspective. All the rest of the charts are bullish on an intermediate perspective. Our worst performer today was energy. You'll notice that energy was down 2.26% today. So I noticed a lot of oil companies kind of getting hit here today after experiencing a nice little run kind of in the last several days as a result of rallying crude oil, a lot of it having to do with the cold temperatures down south. So a little bit of give back here today, a little bit of profit taking, but again, not trend changing in nature. The oil companies are still in a pretty strong chart, and we saw Chevron get bid up here a couple days ago off of Warren Buffett's investment. And of course, Chevron, one of the largest oil companies here in the United States. So that goes a long way with something like XLE. Chevron and Exxon make up a huge percentage of the overall assets of XLE. So as long as they're still getting bid up, that bodes well for that entire sector right there. in terms of who did well today, I guess it's more of a question of who didn't just fall on their face. And it was actually the utilities that could actually claim a reasonably good day. It wasn't spectacular, but hey, a win is a win. They were up 0.6% today here. So that's a good sign. And, part of that might have been what I mentioned before. We had a little bit of a rolling over in interest rates. And so that kind of hurts the financials, all else being equal, and it kind of benefits the utilities, all else being equal. And we did see that relationship hold true here today. But we still have that intermediate background color pink, so we don't want to read too much into one single update that we had here with the utilities. All right, let's get into our trade application example now, and it's going to come from the technology area. As you can see, technology is still in an uptrend here, above its rising moving average, still has a strongly bullish posture up here. And so we also have kind of a long lower shadow that is kind of bunching up right at the tops of those candles over here on January 25th and 26th. So hopefully that idea of old resistance becoming new support can hold true for this trade idea as well. Let me pull up chart 3A. And the stock is kind of a goofy name. It's Datadog. And remember, this trade has already been done. I've already sent out these alerts to all of you during the trading session, those of you that are premium members of Market Scholars. So it gives you a heads up, an information edge, as it were, if you want to take the trade before the next day. Now, that doesn't always work out, right? Sometimes the stock market doesn't go the direction you want, and you're actually better off having waited. But nonetheless, at least gives you a moment to kind of think about the trade and whether it's appropriate for your own account or not. But anyway, what attracted me to Datadog here was not just the fact that technology seems to be holding up, and this is kind of one of those cloud software types of companies, but you can also see that despite having pulled back here quite aggressively in the last week and a half, we still maintain strength from an intermediate perspective. I should clarify that. I don't necessarily mean the intermediate line on the market forecast. Instead, what I mean is an intermediate time period, like a few months, right? This is a 3-month chart here. It's up 23% in the last 3 months. That is outperforming the S&P 500. Notice that dotted line right here is well below the price action at this moment. So despite what feels like a really healthy give back right here, we're still outperforming despite that big give back. This is a more volatile stock, right? We had a healthy give back with it back here during this late December time period as well, and it eventually went on to hit a new high. So that's kind of what I'm banking on here. Whether it happens or not is anybody's guess. A lot of it will be dependent upon the market itself, but at least I have some clues on the board here as to why I might be interested in being bullish on it. First of all, you can see the background color of the chart change from pink to blue on today's candle. And the reason for that is the blue near-term line on the market forecast went from being in a bearish position to now popping out of that lower reversal zone and being considered bullish at this moment in time. In addition to that, it was a big enough pop higher here today. You can see that the moving average changed from yellow yesterday back to green today. So that basically means that, hey, we've reclaimed that moving average. Price is now back above a rising moving average. We also have what's known as a Cahold setup here. Cahold is just an acronym. It stands for close above the high of the low day. And yesterday would have been the low day in the most recent move. Today, we closed above yesterday's high. And we didn't breach yesterday's low at the same time. So gives us a sensation that the bulls were stubborn to the upside on this one today, closing it higher by over 3%. And of course, today was a down day for the overall market. So on a relative basis, this was clearly an outperformer here today. So what I'm hoping for is that the sell-off that we experienced in the last couple of weeks is largely through. It's going to establish some support here and bounce up and off of that moving average. You can see I've got a stop loss down below here, which is below some of these candles back over here on January 28th. And then that means my 1-for-1 reward risk upside price target is up here in kind of this general range where it traded for about 4 days back here at the beginning of February. It does not require a breakout before we would take our profits. we would get out before that. So we'll see how that works out. If you need the specifics on that trade, again, that's what I make available for those of you that are premium members of Market Scholars on our Telegram app. So that's what I had for you here today. I hope you enjoyed the presentation. I hope those of you, especially down in Texas, are staying warm. Some of you saw my post of my older brother down in Austin, Texas. I got a kick out of it. He's outside grilling on his propane grill, wearing a stocking cap right next to his pool, where he's usually just hanging out and capturing some sunshine. But the pool looks like it's got some ice on it, and there's snow all over the outside edges of the pool. So quite the distinctive look for somebody who lives in Austin, Texas. So I know we have a huge contingent of followers down in Texas in general. So if you're down there, stay safe, stay warm. I know you're dealing with power outages and frozen pipes and all kinds of slick road conditions and everything else. But hopefully you'll get through this, and we'll be off to better days ahead. So with that, I want to wish you all the best of success with your trades and your investments. Please go over to Twitter and click like for me if you got value out of this, and we'll see you all on the flip side. Take care. Bye-bye.